Now, as we ended the last segment, we want to start with the second segment in terms of kind of where things are. And it's interesting when you look at the different levels. So the number one risk at this point, or the tail risk at this point, is a systemic credit event, which, as we've been saying since essentially 2020, that we expected rates to start going up, and that was going to create a cascading or domino effect that was going to impact not only banks, but also companies that have been living off of cheap debt and really had no cash flow to speak of to support operations. But that was driven by inflation, which is why we said rates were going to go up, because we thought inflation was going to surge because of the massive amount of monetary policy getting dumped into the market. So, but now think of it. So central banks stay hawkish is a risk, and they have to stay hawkish because inflation is still high, and inflation is still high. Therefore, the hawkishness of the banks have to keep rates elevated, and then those elevated rates create a credit event. And that's why, even though they're three separate things, each one is linked to the other in different ways. So when you start looking at this, there's an assumption that there's almost 100% chance that this is going to happen. It's just which one is the spark. And the reason why I say this is because there's an assumption that central banks pivot, but if inflation stays high, they can't pivot. And if inflation stays high, they don't pivot, they keep rates where they are, and then that leads to the credit event. And you can kind of see how it's more of like a circular argument versus something that is separate and separate from each other. But they're inherently linked, which is why you start to see a broad margin contraction, because people are concerned about pricing, they're concerned about CapEx, so they're seeing their margins get compressed. And as margins get compressed, people pull back. They don't invest, they don't issue CapEx, they don't hire, and that is starting to kind of pick up, especially when you look at it's the broadest in 22 years. So then when you look at the Oxford economics system, looking at the U.S. business cycle, you can see that it had a fairly steep contraction versus where things are. So the sharp fall in their U.S. business cycle indicator in February signaled the economy lost momentum midway through Q1. All 6 of the underlying indicators were weaker, led lower by a drop in real manufacturing activity, real personal spending, and incomes lost the least ground. So that's the important piece, because real personal spending and incomes lost the least amount of ground. They fell, but not that aggressive, which is why we've been saying, for a while now, that is going to be that last shoe to drop. And when it finally does, which we think we are either there or very close, that's when you're going to see a steep drop in activity. And that's when it's going to come out of nowhere for the most part. Not to say that it's not been warned, but it's really hard to nail down exactly that pinpointed period. So then when you start looking at, well, how were banks preparing for this? Well, through beginning of April, both loan demand and credit conditions deteriorated, according to Dallas Fed Banking Conditions Survey. Both have reversed lower and are near the worst since pandemic erupted. Both series are limited and only back to 2017. But it gives you an idea that not only are credit conditions worse, which means that banks are unwilling to lend or making the credit needs much higher, but also people don't want it. The businesses are like, look, you're charging X amount of rates. You need this amount of information, not doing it. And they walk away. So you get both of that, but each of these reduces the velocity of money. And that's, I think, a big piece of what needs to be watched when we're looking at monetary policy, because if the velocity of money really kind of nosedives, we're going to have to look at what are the ramifications from that, and then does that create a higher chance of that systemic credit risk because of the lack of movement and the lack of availability of dollars in the system. And that's when you start looking at some of these very key pieces with the 18-month forward 3 months and the spot 3-month spread. And you can see that the inversion is the worst it's been going back to 1996. And you might be thinking, well, why are we talking about this? Well, according to Powell, his preferred yield curve indicator is this metric. So it's important when you look at it, where he's been saying, look, everything is inverting. I get it. It's a problem, but this is the one that's important to me. And now when you look at going back to like the previous chart, going back to 1996, this one always only goes back to 2007, but this is not a healthy look. This is not a healthy chart. And this is something that's going to cause him to have a bit of a pause. And realistically, when you start looking at bond volatility and some of that fear, is actually when they should be cutting rates, is when they should start seeing some of this pivot. But then when you look at inflation, which just came out, which we'll talk about in the next segment on PCE levels, if you start looking at some of the median numbers, inflation's not going down. So that's where you get this problem, especially when you start looking at unemployment rates remaining depressed. It's going to be difficult for them to adjust, which again is going to put more pressure in the system, which is why we do see central banks staying hawkish. We do see the Fed staying hawkish because inflation is elevated, which then elevates the chances of that systemic risk. The cost to protect against the U.S. default is on the rise as a long-term debt ceiling deal seems increasingly unlikely. And that's not something, again, it's always a political what's the right way? Bargaining chip, and that's something where they'll come up with some sort of solution. They always do. It's just a way to move someone's agenda. But in the meantime, we continue to see a lot of fear, and the fear is in the way of the MOVE index. So we've talked about the MOVE index before. This is not something new. And the MOVE index is just looking at bond volatility. And so it's measuring the implied volatility of 1 month options from the 2-year note to the 30-year bond. So you're looking at a fairly wide variety. And this, volatility could be up and down depending on direction. Obviously, if it trends up, you get a bleed down in volatility. As it trends lower, and then even if the bonds are continuously going lower or yields going lower, same thing. So there's a lot of gyrations with yesterday's close, I should say, coming in at 153.9. And the shaded area is showing you 2 standard deviations. So 143.9 is above the shaded area and means it is one of the 5% highest readings in the 30-plus year history of this specific index. So what is the interpretation? So the VIX, if the VIX were to close at over 35 and near 40, not the current 19.08, on again, VIX is looking at equity volatility, you get an idea that there is a stark difference between the two. And typically when bond volatility goes up, rates come down and QE increases. But we can't do that right now, which is why we've been talking about how the Fed and other central banks, not just to pick on the Fed, have really pinned themselves into a corner and don't have the ability to lessen some of that pain, which is why, realistically, who is right, the bond market or the equity market? Bond market is saying there are problems, and the equity market is laughing and saying, I'm still buying the dip. And it's just going to be a matter of who is right, or are they both right, and you get a move down, but not to the same degree that I think the bond market is telling you. So then when you look at the U.S. the conditions of all Federal Reserve Bank total assets, after an increase over the past several weeks, the Fed's balance sheet registered a decline. And this is the question of what is off balance sheet, what is on balance sheet. And that's when you start looking at those dollar swaps, that swap line when you look abroad, because what we're doing is we're putting loans on the books, but the liquidity is entering the market in a separate location. So we're not getting the liquidity here, we're getting the liquidity in another area, which then is looking at, okay, well, is it going to do something to the euro dollar? Is it going to do something, or is it just going to sit on their sheets to shore up balance sheets and to show inflation isn't an issue? And that's, I think, a big component of what needs to be looked at. But again, these are just some movements between, trying to manage expectations and balance sheets. So then when you start looking at the Challenger cut, they showed an increase of 319% year on year. It's the 5th consecutive month of triple-digit gains. Tech companies have announced 102,391 cuts so far this year, on pace to surpass the highest annual total for the sector announced in 2001. But you also have to think they also did a lot of hiring. So is it just moving back down to normal? Is it going to go past that normal? And those are some of the key things to watch. And the percentages sound scary, but you have to put it all into context when you're thinking about what the numbers are. So still almost 800 companies have shed about 473,000 jobs, total number of jobs cut since October. But there was that big hire back. And now the question is that, how many of these people are being fired or bought out? And that's where you're starting to see some of these, or let go, softer term. But when you look at energy is seeing the least amount. And it's because labor's been very tight at the energy level. We've seen it at the frac spread count. We talked about it yesterday on our call with Susquehanna, because we do expert calls once a month. And there's a lot to be said about that. But when you look at tech, which was so bloated, consumer discretionary was so bloated, now you're starting to see this come back down to normal. The question is, does it continue? Because when you start looking at U.S. job openings, and this is what we're talking about, they've come down, but look at where they are versus historics. And then job openings, you look at where they are versus historics. Sure, they've come down, but they're still well above normal. So there still needs to be some of that adjustment when you're looking at job openings. And that's, again, keeping those wages elevated. As we showed earlier, wages have come down a bit, real wages, but not to the same degree. And this is why, because there's still that competition. Job opening, total non-farm unemployment level. So it's just looking at the number of jobs available per person who's unemployed. Obviously, there is still a significant available. But then this leads us back to, well, what's happening at banks? And this is when you start looking at some of the nuances of what banks are at risk. So you look at like BNY Mellon, which is the second in the most uninsured deposits. But that sounds scary. In the back of your head, you're like, well, didn't that bring down SVB? But then you look at their maturity and securities and deposits, and essentially how they manage deposits to loans and their hedging. And you can see that SVB had 94% issue and BNY has 31%. So you're looking at a very different metric where, sure, they're uninsured, but where are they on their loan cycle? Where are they on the lending? Where are they on hedging? And you can see it's a bit more insulated versus others. But this just puts into perspective some of the risk that is out there that continues in the system. And as we showed, I think it was 2 weeks ago, or it could have been 3 weeks ago, we talked about the thing that the Fed, when they did their stress tests, didn't look at is what happens if you have an increase in interest rates. Everything's looked at what happens if interest rates fall, what happens if liquidity tightens up, but what happens if interest rates rise? And I think that is, and you get an idea of how systemic it is and how it's been so ingrained that, well, rates don't go down, so why does it matter? Rates don't go up, so it shouldn't matter, but it does. And that's one of the things that we've been trying to drive home in everything that we've done for the last 2 years, is that rates were going to go up no matter if people wanted it or not, because of this fear, because of the systemic problems. So then when you look at the monthly change in bank deposits, the U.S. banking system, you saw the largest loss in deposits in history. So there was that fear of, well, how many deposits are going away? But look at the extremes. And this is what we've tried to talk about, because everyone only looks at the red. Nobody looks at the blue and the fact that there's been a significant addition of deposits. So this could just be people saying, look, I am overexposed here. I need to go here. I need to go over here, and I need to disperse all of this. And if anything, maybe I'm going to take some of this out and hold it in my treasury account, hold it at something that is a bit more stable that I don't have to worry about, which may be a 6 month, 2 month, 1 month treasury bill, something, or CDs, something that may make this look worse. But again, it's still something to show that people are showing a bit of panic. Then when you look at people who are looking to move over the next 12 months, it's the cost of living. The cost of living is still the main driver of when people look at things, because it's getting harder and harder to finance a family. And again, I think there was an article that came out yesterday that was looking at a single person looking for, I think it was a car, a house, and something else. And it was like San Francisco, I think it was $85,000. And you were looking at Well, what happens when you add a wife or a husband to that, and then you have 2 kids, and all of a sudden these numbers become shocking where, you think, oh, well, I need $200,000. If I make $200,000, I'm going to be set. I'm going to have money going into savings. But then for anybody in New York or some of these high price areas that are making 250, 300, and then you turn around and you're like, oh my God, I have nothing to put into savings. And that's when you start to get this cost of living shift. And the other thing that's making it harder, back to the PCE comment, is this median PCE inflation, core PCE. All of these are flatlining. And that's what we've been talking about going back to 2020 into 2021, when the view is this is transitory. And transitory meant that it would go up and come straight down. And our view is it's going to come up, it's going to come down a bit and go sideways. And that's exactly what's happened. And we're not making this up. My degree is in macroeconomics with a focus in rates and currencies. So I'm a monetary policy freak. That is what I love. And that's why when people are like, oh no, you're crazy, it's like, I'm just telling you what theory says, and then I'm taking that theory and applying it to what is currently in the market, which is inflation's not going down, and it's not going to go anywhere down near anywhere the percentage that you're expecting. And that's something that continues to play out, and we think continues to play out over the next couple of months, next couple of quarters. So global sales of syndicated loans fell 43% in the first quarter, the lowest since 2010. And again, it just comes down to the inability of companies, countries to get these loans done. And that's, again, that if you can't get a loan done, well, then you're not going to build a new facility, whether it's a new manufacturing or a new warehouse or something. And that's, that's permeating the system, creating some of these additional slowdowns. Loans and leases to banks, you can see that there was that contraction, again, leading to the same thing we've been discussing, which are these pressure points when we look at the economy and that cycle of activity. PC core services ex housing, which is the most watched by the Fed, still looking very sticky. No matter how you look at it, the 3-month annualized ticked up to 4.85%, while the 6-month annualized moved down, but down to 4.9. Again, you're not seeing 4.9 to 3, you're seeing 5 to 4.9. This is not the level of data that they want to see, which is why we're going to get another rate hike. We're going to get some more pressure, and this is going to keep driving things higher, especially when you start looking at the pressure that is that's mounting on different sides of the economy. ISM manufacturing 46.3 versus the estimate of 47.5. New orders down to 44.3. That is a big drop, not the lowest for 2023. But again, as we said, nothing dies in a straight line, but you're getting lower highs, lower lows, moving in the wrong direction. And then at some point, you're just going to level off and you're going to start chopping back and forth, which is what we continue to expect. Prices paid moved back into contraction at 49.2. Again, this does not carry the OPEC cut and the movement back up in crude pricing, which is something that is going to keep us kind of stuck around this 50. And production edged slightly higher, but again, still contracting at 47.8. But employment finally turning down and the lowest since July 2020. Now, on the March ISM side, ISMs fell. The estimates for 54.4 came in at 51.2. So you're starting to see a sizable slowdown in the consumer, but still expanding, just at a much different rate. And this is going to be the key one to watch. And back to the comment from the Oxford guys, this is what they were seeing. By the middle of Q1, you were starting to see a cycle lower, and this is now, again, showing that cycle that they saw where the first half of February was strong, January, February was stronger, things started to slow mid-Feb, and then they continued to get a bit worse in March. Huge drop in new orders from 62.6 to 52.2. Again, in a very important metric. Prices receded from 65.6 to 59.5. Something that is a good trajectory for inflation, but you're still moving it north of 60, which is still very strong versus historics. So then when you start looking at the gap between employment metrics and the ISM manufacturing, much worse versus services, and that's They'll meet in the middle somewhere, but we think that the service is going to give up a bit more of that pressure versus the other way around, where prices component within ISM services catching down, moving further down. Again, it's going to be a bit of a meet in the middle, but you're going to get some of those movements. But look at that orange line, which is the service price. Even though we were coming down to that 60, that is still some of the highest we've been going back to 2009. So again, you still have a lot of that pressure increase, which is why we talk about core inflation staying elevated, core being a problem when you look at spending. And then the ISM contributed to headline ISM services. And this is just the breakdown of it. So, barely an expansion. Activity came in at 55.4. That was down almost a point. New orders down 10 points. Employment down 2 points. Backlogs down 4.3, coming into 48.5. That's a problem. Again, backlogs and inventory is one of the key pieces that we've been talking about, where we keep seeing some of these bigger shifts in availability. And again, how people are managing their backlog and their inventories. So then inventory levels, again, are being managed. They're coming back down. And the reason why is because customer inventories are rising. So they don't need the same level of inventories at the manufacturing side. And you're going to see this balance out, which will be less of an uplift or downdraft. Works both ways for that GDP calculation. And all of this is leading, when you look at the Chicago PMI, which has struggled to regain any type of momentum. So you had that bounce. Now you're drifting back lower, and it hasn't yet made it out of contraction and continues to hover at these recessionary territory, recessionary territory, and we don't see that changing. And you can see how low it is going back to 1980 to give you an idea on just another metric of that pressure point. And given where inflation is, given where employment is, you're not going to get any support from the Fed in cutting rates, which again is going to pull this down further, making that systemic credit problem more and more of a reality. So that's what we have for you on that level. In the next segment, we're going to go deeper on the consumer and what are some of those nuances on that consumption side.